Earlier this year, we made a video about how the home buying process works here in Georgia, since this process can be so different from state to state. Now that the market has begun to change and shift, we are definitely seeing things happen and contracts getting accepted that frankly never would have been accepted back in 2021 or even 2020. So now that things have begun to normalize, how does the home buying process work here in Georgia, and how are we going to put together a successful offer? Hi, I'm Sarah Maslowski with KeyPoint Homes Group, a real estate team serving the North Metro Atlanta area. We make these videos to help educate people just like you that are watching, that are interested in relocating here to Georgia, to make this process as smooth and seamless as possible. So here's everything you need to know about how the real estate process works here in Georgia. Earlier in the year and during the madness of 2020 and 2021, the real estate market was bonkers. Buyers had to be as competitive as possible, and in most cases, they had to go over asking to get an offer accepted. This also meant having very short contingency periods and basically removing any option of terminating the contract in order to get the house secured. Many buyers were desperate to get into a home while interest rates were still low, or while they decided what area they wanted to be in, or whatever their driving factor was. As the market begins to normalize, buyers don't have to be quite so aggressive anymore. Now, this doesn't mean that you can just waltz in and buy any home you want to on whatever terms you want, but we definitely don't have to fight tooth and nail like we did over the past 2 years. All right, so how does this work? Home shopping is obviously one of the biggest parts of the transaction, and we've made a couple of videos about how we help people who don't actually live here in Georgia go out and see houses and see them for the first time. Now that you've found the perfect house and you've gotten pre-qualified by a lender, it is time to put in that offer on your dream home. Writing an offer means that we write down all of the terms that we want to present to the seller in hopes that they are going to be attractive enough to our offer and accept that contract. Now, one thing you should know is that it's not set in stone until the seller actually accepts that offer, which is then it becomes what we call a binding contract. It's bound. We have an agreement. It's official. Whenever we're writing our offer, we're just writing up what we're offering. Those terms can still change. It's a negotiation. So one of the first things we will discuss when writing your offer is your due diligence period. What is this? This is the time that is built into the contract that allows you to terminate here in Georgia for any reason you so choose, while still being able to get your earnest money back. This time period is typically used for home inspections. And like we just talked about, a few months ago, we were doing very, very short due diligence periods, if any at all. We went from a normal market where it wasn't uncommon to see 7 to 14 days due diligence periods to a 24-hour due diligence period, to a lot of people saying, heck, we're not even gonna ask for a due diligence period. Now that things are shifting in the market, we are starting to see a return back to normal, and buyers are getting more contracts accepted with a more standard due diligence period, most of the time between 5 to 7 days. The due diligence time period is typically the time period when you as a buyer are going to want to have the home inspected. That time period gives you a chance to do all the inspections that you want in the house to make sure that the house is in the condition that you want, or to negotiate any items that you may uncover during that inspection. Recently, we had a client ask if they could have an inspection done on a home before they had even written an offer on the house. Now, we would never want to do this because someone else could come along and put in an offer on that house and get it accepted. And that home inspection that you just paid for is a whopping $500 home inspection, and you're not even in a contract. The house doesn't even have your name on it or have a hold with your name on it. Now, there's literally no harm in putting together an offer with the due diligence period. Like I said, you have that time to have the home inspected by a general home inspector. We can get a septic inspection, a termite inspection, the AC's inspected, mold inspection, anything that you want. You can have that home inspected during that time period. Based upon those results, you have the ability to negotiate with that seller based on what the findings are. Now, during this time period, you as the buyer client are responsible for all of those inspections on your own. Typically that home inspection, it runs between $400 to $500. We mentioned a termite inspection. That is something that we cover as a service to our clients to make sure that you're taken care of, and we cover a 1-year termite bond as well. So that is something that you get as a service when working with us. So this is something that you do want to keep in mind, the inspection fees that you are going to have to pay if you do move forward with having a home inspected. Now obviously we always recommend a home inspection. It's a great thing to do. And so whenever you put an offer on a home and you get it accepted, just know that you're likely in that home already for around $400 to $500 just in home inspections alone, even if you decide to back out of it. You're not getting that money back. It's a sunk cost into the house. However, if you think this is the perfect home and you still have all those inspections done only to find out that there is a massive structural issue or mold or whatever it may be, you can walk away from the house during that due diligence time period and get your earnest money back. You cannot, however, get back the money that you paid for those inspections. So speaking of earnest money is typically 1% of the purchase price of the home that you are paying for, and it is due upon acceptance of that contract. Now 1% is a general rule of thumb, but this is negotiable. So back in a normal market, back 2019 prior, we were seeing, $1,000, $2,000, $5,000 as acceptable earnest money on a house, and sometimes that was still well below the 1%. So just know that a good rule of thumb, if you want to offer a strong offer, 1% is a really great strong offer for earnest money, but it is negotiable. So the purpose of that earnest money is to show that you have skin in the game, that you as a buyer are very serious about moving forward with this contract. Let's use that 5-day due diligence example, and let's say that you are 7 days into the contract, you're outside of your due diligence process, and you just wake up and you're like, you know what, I'm just not really feeling this house, it's not for me, or I just saw one that was listed down the street and I like that one better. If you terminate your contract, you do not get that earnest money back. That earnest money becomes the seller's. Now, if you change your mind during due diligence period, however, you do get that earnest money back. That's the only time period that you can walk away scot-free and get your earnest money back. Now, what happens to that earnest money? That earnest money, as you move forward in the contract, and let's say that you make it all the way to the closing table, that money goes towards the amount of money you are putting down on the home. So it acts as a credit towards your down payment or your closing cost. The next thing we will discuss is when you want to close on your house. Your closing day in most situations is the day that you take over possession of your home. The minute you sign those papers, the house is officially yours and you can move in right away and do whatever you please. The standard closing time period here in Georgia is 30 days. During this time period, the attorney is making sure that the title is clear on the home, that there's no liens, your lender is collecting documents and finalizing all of the closing documents for your actual loan, and they're making sure that you are financially set and that they are able to approve your loan and finalize it. Now, during the last 2 years, we saw many sellers asking for temporary occupancy post-closing. This basically meant that the sellers were able to stay in the house after they've already sold it to you and they've gotten their money for however long they needed. The typical time period that we saw was anywhere between 2 to 6 weeks of staying in the home. And for most of the time, this was meant that they were living rent-free in your new house that is technically their old house. So this meant that after closing, they got to stay in the house for a few more weeks or however long was agreed upon until they could move into their new house. Remember, we were just exiting a market where sellers could pretty much determine anything that they wanted. As the market begins to shift, we are seeing less and less of this happening. We are beginning to go back to more of that normal practice of just having a longer transaction time period or having the sellers vacate the home prior to closing so that whenever you sign on the dotted line, the house is yours, you are walking into an empty house. Now, the next thing that we want to discuss is we have very important sets of dates that we are going to discuss in your offer. So when you obtain a loan to purchase a house, there are 2 contingency dates that act as a safety net to make sure that you could actually qualify for a loan for the house and to make sure that the bank agrees that the house is worth whatever price you're paying. A financial contingency is what protects you in case a lender finds out that you can't afford to purchase the home, or if something were to come up that wouldn't allow you to be able to afford a mortgage payment anymore. Let's say like losing your job, or not getting a commitment letter from a company as previously anticipated. Again, in the past, people were trying to keep this financing contingency period as short as possible, and we were seeing people either completely waiving this or having a very, very short time period. Now we are starting to go back to a normal market where we are starting to go back to either a short contingency period just for the sake of protection of having a solid 2 weeks to kind of like finalize that loan or get everything together and kind of have a buffer. And we are also, so anywhere as short as 2 weeks to a typical time period is around 21 days for a financing contingency. This again gives the lender the opportunity to really make sure that there are no skeletons hiding in your tax returns or anything like that that would prevent you from being able to move forward with the loan. Now, if you are partnered with a really great lender, which we have excellent lenders that we recommend, they are going to do a solid, thorough job of making sure and doing all this due diligence work before they even issue that loan pre-approval. So a lot of times people were waiving this financial contingency period because they were working with really great lenders who they were solid on that loan approval. They knew everything because they had been in and out of the files and they had been in and out of all those documents that you had given them, so they knew that if they approved you, it was because you were a very, very, very solid buyer. Now, knock on wood, I have to say that with the lenders that we recommend to you, we have never had anyone that's been pre-approved where those lenders were not able to close on that home and get our buyers to the closing table. So you have the financing contingency period, and you also have a period called the appraisal contingency. Now, this appraisal contingency protects you in case the home does not appraise for the price that you were under contract for. This was a huge sacrifice that many buyers were giving up in the past 2 years. Essentially, the bank has to approve and has to have your home appraised to make sure that they are not lending you over and beyond what they see that your home is thought to be worth. Now, if you thought that your home was worth well beyond what the bank thought it was worth, then you were going to have to make up that difference in price because you can only get a loan for the amount that the home appraises for. So it wasn't uncommon for us to have a house priced at $500, have someone offer $550, but that $500 price was what the house was probably going to appraise for. And then buyers were bringing that $50,000 to the table to cover that appraisal gap. So over the past 2 years, it was very, very, very common to see people waive appraisal contingencies, meaning that they didn't care if the home appraised for less, they knew that they were going to have to pay out of pocket. We are now starting to see a return to normalcy. And so what this means with an appraisal contingency is that you have time to have your appraisal ordered. They're going to come out, they are going to look at comparables, they're going to look at the inside and outside of the house, they're going to do a fantastic report, and they're going to come back with a value for the price of that house. 9 times out of 10, that home is going to appraise for what you are under contract for. And in a normal market though, sometimes it's not unusual to see a house appraised for less than what you were under contract for. So in those scenarios, with that appraisal contingency, you have the ability to go back to the seller and say, hey, we offered $500 on this house, it appraised for $490. We're going to reduce the offer of our house to match the appraised price of $490. So the seller at that point can say, sure, okay, we agree. Everyone moves forward and goes to the closing table. The seller can say, no way, we agreed at $500, I want $500. Then at that point, you as a buyer have the opportunity to come up with the funds, the $10,000 to cover the difference. Or you as the buyer can say, no way, Jose, I'm not paying that. It's only worth $490. That's what it appraised for. I'm getting out of this contract. If you get out of the contract during that appraisal contingency because of the appraisal, you have a legal means to do so, and now you get your earnest money back and you walk away essentially scot-free from the house. You are spending the time that you have invested negotiating and planning for that move, and then you also have the amount of money that you have paid for and home inspections invested in that house as well. 9 times out of 10, when there is a discrepancy in the price, the seller at that point, usually you're like 10 days away from closing. They've made plans, they've ordered moving trucks, their houses and boxes. They don't want to go back on the market. So 9 times out of 10, they do negotiate and try to come up with a win-win solution to keep everything in place and moving along towards the closing table. So over the past 2 years, appraisal gaps have been put into the contract, or people have said, heck, we're waiving our appraisal contingency. We don't care what it appraises for, we're still buying this house. We are not seeing that anymore, and we are seeing that normal appraisal contingency back into the contract. That time period is usually between 14 and 21 days that the lender has to get the appraisal out there, get a value back, and that's the time period that you have to negotiate if there's any discrepancies on that price. It's funny, I get this question sometimes. What happens if that appraisal comes back and it's higher than what you were under contract for? So say that you're under contract for $500 and that appraisal comes back for $515. Well, you, a buyer, have hit the lottery and you have instant equity in your house, and that is the best case scenario for you as a buyer. The appraisal is only ever shared with the buying side, so the sellers never know the value of that unless you verbally tell them. So you never have to disclose to the seller what that appraised value actually came in at. Obviously, if it comes in low, you're going to want to share that value with the homeowner so that you can make sure that you can negotiate that difference. Now, something that we never would have dreamed of doing a year ago, or heck, even 6 months ago, is called a home to sell contingency. This means that the purchase of the home that you're writing a contract on is contingent upon the sale of the home that you currently own. This means you can say, I would like to buy this house. However, I have to make sure that the one that I already own currently sells. We never would have asked for this when the market was so crazy like it was a year ago, year and a half ago, because this is a huge risk to the seller. When you are in a massive seller's market, you obviously want to do anything you can to get your offer accepted, and you don't want any risk in there at all for the seller. And so we never saw home to sell contingencies being accepted or heck even offered. However, that is changing. In fact, our team is currently working with several clients who have this very contingency in place on homes they are purchasing and under contract right now. This is great news for sellers, and it's a great thing if you are needing to sell the house that you're currently in and purchase at the same time. Now, the last big piece of a contract is that type of financing where you are going to have to pay for the home. During the last 2 years, a conventional loan or a cash purchase was seen as the most preferred option to sellers. And so it was really hard for a lot of buyers to get under contract using an FHA or a VA loan. Financing is an entire beast of its own, so we'll have to make a whole video about the different types of financing. So leave us a comment below if you have any specific questions about financing. And so even though cash and conventional loans were most accepted over the past 2 years, as you can imagine with the shifting market, we are starting to see a return of contracts being accepted with FHA loans and with USDA loans even. There's some areas that we serve that qualify for 100% USDA loan financing, and of course our great veterans with their VA loans. So those are great news, and those are everything that kind of goes into writing an offer, and those are the things that a seller considers. Now, of course, prior to actually writing that offer on the house, you want to make sure that you are with a fantastic real estate agent that's going to go over everything in detail and come up with a really great game plan based on what you as a buyer are comfortable with. That way, when it comes time to actually writing the offer, these are things that you already know and that you've already discussed with your really amazing real estate agent like us. And if you are thinking about making a move to the North Metro Atlanta area or anywhere in Georgia, reach out to our team. Our contact information is below this video. We would love and be honored to help you. And of course, if you're thinking about making the move, you have to check out this video.